on this edition of Next Africa. Ethiopia powers a new future. The $5 billion Grand Renaissance Dam is now online, but it's also deepening a years-long dispute with Egypt and Sudan over the flow of the River Nile. Plus, Donald Trump's trade war is fueling the South-South trade. Indian automaker Mahindra is betting big on South Africa's Baki market, challenging Western rivals. And Africa's biggest e-commerce player, Jumia, is riding a supply chain shift from China, turning trade tensions into fresh momentum. Welcome to Next Africa. I'm Jennifer Zabasaja. Ethiopia has switched on Africa's largest hydropower project. The Grand Ethiopian Renaissance Dam will power homes and industries across East Africa, but has been a source of tension with Egypt and Sudan over the River Nile's flow. Samuel Etienne explains.
Africa's largest hydropower project, the Grand Ethiopian Renaissance Dam, or GERD, has gone live. The plant, which took 14 years to build, at, get this, an estimated cost of almost $5 billion, sits on the Blue Nile in Africa's second most populous nation. It's designed to generate just over 15,700 gigawatt hours annually. That's enough electricity to light up Ethiopia and send surplus power across East Africa. Now, for Addis Ababa, this is a national milestone, and yet its construction hasn't been without contention. Now, downstream in Egypt and Sudan, they remain uneasy and warn of drought risks. And Cairo, which depends on the Nile for the bulk of its water, is still pressing for a legally binding deal on how the dam is operated and filled. Meanwhile, Washington is closely watching developments. President Trump claimed the dam will substantially reduce water flowing into the Nile. But Ethiopia is hoping the dam will help power the next phase of the country's ambitious development plans. And they're targeting almost $500 million in revenue from power exports in the current fiscal year, which runs through to July.
For more, we're now joined by Bloomberg's Fasika Tadesse, who attended the dam's launch. Fasika, thanks so much for joining us. Talk about what kind of economic impact Ethiopia is hoping to see from this project after so many years. Is the government eyeing specific sectors or growth targets for the long run?
Yes, Jane. So the government is hoping to see several or quite a couple of economic impacts that could be brought by the dam. The first one is industrialization. So the industry sector, which accounts about 30% of the economy, is growing at an annual 10% rate. And then parallelly, the energy demand from the industry sector is growing, but by 40% on a yearly basis. So the government hopes to fill this growing demand from the electricity generated by the dam. The second one is export. And recently, the Prime Minister said the GERD could help the country to generate $1 billion a year. So when we see this figure in a context in the past fiscal year, the Ethiopia in total generated like $8 billion from commodity exports. This means a huge amount of money that Ethiopia expects to get from the dam. And currently, Ethiopia is exporting power to Djibouti, Kenya, and Tanzania. So during the inauguration ceremony, the leaders from those countries were saying that they are keen to buy more power from Ethiopia. The third aspect is the Bitcoin mining. So recently, Bitcoin companies, mining companies, especially those from China, made Ethiopia a destination. And so far, Ethiopia has 25 operational Bitcoin mining companies that are connected to the national grid, because since Bitcoin mining is a power-intensive industry, so 20 more companies are on the pipeline to get connected to the national grid and get power from Ethiopia. So that's also the other benefit Ethiopia is hoping. And the fourth one is increasing the national electricity coverage. So with 130 million population, half of Ethiopia's population, especially living in the rural area, are not getting power because of transmission line infrastructure unavailability. So the government hopes to use the revenue generated from the export of power to build the infrastructure and connect those people with no power into the national grid and get power supply.
So quite a few proposed benefits domestically. If we think about internationally, though, the construction has been quite controversial and also been cause for quite a bit of contention. What is the latest with that and with some of the disputes that we've seen about this dam from some of these other regional actors? Yeah, Jen, as you said, there is a diplomatic rift or tension between Ethiopia and the downstream countries, specifically Egypt and Sudan. Since 2015, the three countries signed a declaration of principle and to start a negotiation on how to operate the dam and also the water filling of the dam. So apparently, the three countries have been the negotiations back and forth between the three countries, but the negotiation couldn't bear fruits. And even third parties like the US and Saudi Arabia tried to mediate the three countries, but still no agreements have been reached on that aspect. So the negotiation started before the dam is completed and the reservoir started catching water, but still no agreements, and the reservoir caught about 74 billion cubic meters of water, which sparked a fear from the Egyptian side, saying it will significantly reduce water flow to Egypt. So saying that Ethiopia completed and officially inaugurated the dam, and Egypt was not happy with that. And recently they said they will be appealing to the UN Security Council for action. But Ethiopia didn't give a response to that. But during the inauguration ceremony, the Prime Minister was saying Ethiopia is still to continue the negotiation with the two countries, and the country doesn't have an intention to harm those countries. So no official response from the government on the dispute they're having with Egypt and Sudan.
Coming up, the collapse in diamond demand has pushed Botswana, the world's second largest producer, into recession. We'll get you my interview with President Duma Boko on the state of the economy. And in the latest installment of our Investing Africa series, Richard Okello, co-founder and partner at Sango Capital, shares why private credit is poised for growth.
Investors' perceptions of risk in Africa are largely significantly outdated relative to what the reality is today. There's lots of headroom for private credit. And today, that private credit is being provided in a very unorganized fashion by people who have money lending to others at
globally, you're saying?
rates. Not just in Africa, in an African context. So what you're starting to see is the emergence of private credit funds that are institutional, that take money in and invest and can generate the types of returns that compete globally. So private credit's one. When the world is difficult in lots of other places, it's actually great to be an ignored market. So Africa for the longest time has been a, generally speaking, ignored market for investors. People just don't pay attention. So as a result, it is generally disconnected from what's going on globally. So if you look at what has happened with tariffs in the US, the impact on Africa has been, in my view, de minimis for most countries. If you look at, in fact, for a lot of countries, it has forced them to be much more front-footed about the Africa trade, the new trade agreement that's been in place. A lot of countries are stepping into that.
Welcome back to Next Africa. I'm Jennifer Zabasaja. Botswana's economy is heavily reliant on diamonds, which account for 80% of the nation's exports and a third of government income. The increasing popularity, though, of lab-grown diamonds is creating big disruption in the market, choking off Botswana's revenue. I spoke with President Duma Boko. Here's what he had to say about the state of the diamond market.
The key issue right now for us in the diamond space is the declared divestment of Anglo from DBS. And as you know, Anglo holds 85% stake in DBS. Botswana, the government of the Republic of Botswana holds 15. We are resolute now, and we've communicated a firm intention to increase our stake in DBS to a controlling stake that is upwards of 50%.
Would you go higher than that? Would you
we will
taking it over?
Yes, we'll go higher.
Why?
But because we want to have effective control of the industry. We want our voice to be heard. It's a matter of economic sovereignty for Botswana. We produce 70% of DBS's diamonds through our Janeng mine and Orapa. So we want to have a firm voice in the direction that the industry is taking. We want to have a firm control and involvement in the diamond value chain, including its marketing, which we believe has slacked somewhat over the years. And we now see the advent of synthetic diamonds, purportedly almost seeking to supplant and replace natural diamonds. Well, it is our firm belief and stance that there's no way in which a fake can outshine the real.
What would you say to someone who says maybe this isn't the time for the government to be increasing its stake in De Beers? What is the benefit here, especially when you look at the myriad of issues that the country's facing?
Well, the starting point is the reality that Botswana produces 70% of the diamonds in De Beers anyway. So there's no way in which we will sit back and not take effective control of this resource. That's the first. The second is that we need to also be involved in midstream and downstream in relation to the diamond industry, and also the marketing. So it is absolutely imperative for Botswana at this point, particularly, to take a more active role and increase its stake.
Where do you get the funds from, though?
We have lined up a number of potential collaborators with us, if I may put it that way. We have targeted funders, we have parties, we have the Oman Sovereign Wealth Fund, we have others who are willing and ready to come on board with us. So we are more than ready with the transaction, and we've said the transaction must be concluded by end of October. So we are more than ready.
So you expect to take a controlling stake in De Beers by
Absolutely.
the end of October?
No doubt about it.
What about your concerns, though, about De Beers having to, being difficult or having challenges selling its own stake outside of the country? I mean, are you not concerned? It sounds like you're not concerned right now about the stake.
We are concerned about the diamond industry, but these are concerns we believe we can address. Any challenge that is faced, we will be able to surmount. So we are more than confident that we will.
Have you considered potentially going to the IMF or to other members, international monetary funds or other funds?
Well, we're considering all options.
Yeah.
As I say, the ones that we have on the table are more than enough.
Is there any that you can share with us? Does it have to do with Qatar? I know they made a pledge to
well,
the
yes,
country.
Qatar is ready to invest. The Oman Sovereign Wealth Fund. There are others. We're also in engagements with the government of Angola, which also is a diamond producer. So we are building a consortium that is formidable and that will have full control of the diamond space and will ensure that we market, we position the natural diamond appropriately.
When do we start seeing the changes, though, in the economy? Botswana was recently downgraded. Are you concerned about it losing its status, considering the challenges the diamond market has had on the economy, health emergency that you declared? When do we start to actually see things take a turn?
I think the changes will begin to show. I mean, if you look at the downgrade, is not a result of yesterday's occurrence. It's a response or a reaction to the struggles faced in the diamond industry for an economy that is monosectoral, that has relied on a single commodity. What we are doing now with the economic transformation program is to pivot away from this single commodity reliance and engage in other ventures, as I've indicated, digitalization to unlock the skill and the dynamism of our young people and bring in AI and ensure that we deploy, for instance, telemedicine, we address all the other challenges, and we create light manufacturing, agro-processing. These are the things that we are looking to do. And we believe that in the next, I've set a deadline for change in the country.
Yeah.
I've said within the next 3 years, and I'm confident that it will happen.
Coming up, Trump's tariff war is redrawing global trade maps. We'll explore how automakers from the global south are challenging the dominance of Western players on the continent. Plus, Africa's biggest e-commerce player, Jumia, says shifting supply chains from China are reshaping its business. Welcome back to Next Africa. I'm Jennifer Zabasaja in Johannesburg. President Trump's tariff war was designed to curb imports into the U.S., but it's ended up fueling trade elsewhere. A new S&P Global report finds that trade between emerging economies, so-called South-South trade, has accelerated in the 5 years since Trump's first term. And one striking example is the growing auto trade between India and South Africa. The space has been widely dominated by Western and Chinese car brands, but South Africa's Automotive Business Council says the current situation is a crisis in the making. Andre-Pierre Duplessis explains.
Nice buck.
This is South Africa's best-selling truck, a Toyota Hilux, better known at home as a bakkie.
It's not a bakkie. It's a Hilux.
They're popular for handling the country's diverse landscape, from rural farmlands to city potholes. Produced domestically since the 70s, it's become a proud export. One popular destination, India.
If you consider that India is a market that produces in the region of about 6 million vehicles, and we as a continent are under 2 million, that then tells you that the potential for us to make cars for the continent and to drive this demand, offshore demand, through an integrated African strategy becomes that opportunity.
But when it comes to cars and trucks, it's a two-way street. While bakkies and other models have become a boon for companies like Toyota manufacturing in South Africa, the domestic industry is under pressure from imports, notably affordable vehicles from India and China. Concern is building that South African VW, Mercedes and Ford plants will have to shrink to stay competitive.
We are a bakkie producing country. We're responsible for a big portion of global production. I think we're in the region of we're ranking in the top 10 of bakkie production in the world, purely because we have the right incentive program to support that production. So we won't be able to compete with China and India in certain category of products.
India is the biggest producer of car imports into South Africa, even as sales from China pick up speed, according to data from Milestone.
Demand for luxury vehicles in America has been a big driver for investment in South Africa for luxury brand production. And now we're losing that particular demand.
On the other hand, India's largest automaker by market value believes Trump's tariffs are a blessing in disguise for trade. Even before the US president slapped duties on foreign imports, Mahindra South Africa CEO Rajesh Gupta believed the continent is key to the company's growth.
We never thought that tariff war will happen, and hence we did the plan. We are committed. We know a bilateral trade and doing it responsibly is to build the confidence between two nations and keep growing.
This Mahindra assembly plant in Durban is the biggest outside India. 100 South Africans assemble nearly 1,000 Mahindra pickups each month. Since making the bakkie-inspired model available to South Africans nearly 20 years ago, it's grown to become one of the country's best-selling bakkies.
We were making sense to a certain segment initially when we came, like farmers. They knew that something tough is needed for their farm.
Following Mahindra, Tata Motors plans to become a big player in South Africa, offering a slate of SUVs to the market for the first time. With global South-to-South trade continuing to grow, there will be winners and losers. Mercedes has already cut jobs in South Africa, with other domestic manufacturers saying they may need to do the same. The question remains whether this increasing competition means the nation's consumers will end up in the driver's seat.
It's not just the auto sector benefiting from the South-South trade boom. Francis Dufay, CEO of Africa's biggest e-commerce player, Jumia, says the shift in global supply chains is making it easier to bring goods from China to Africa.
The past 3-4 years for Africa, for African consumers, have been really, really tough.
Yep.
In the 9 countries where we're operating, huge currency volatility, huge pressure on consumers, high inflation. We had countries with like 50% inflation. And all that didn't help for us as online retailers. It means that suppliers were not importing goods from Asia or anywhere because they could not commit the cash, because they had no idea of currency volatility in the next 6 months. It means that Asian manufacturers were not sending goods to Africa because, well, they were scared of the situation. And we just could not really do our job at scale. When we lack supply and customers lack confidence, it made things really complicated. And that happened in the midst of our restructuring as well. So we had all at the same time, to put it this way. What we're seeing now is that with currency stability, it's massively improving our situation because we have goods to sell. Supply is becoming much easier. Chinese manufacturers are shipping a lot more to Africa. Consumers are starting to regain some level of confidence. Some. It's not perfect, but it's better. And cherry on the cake, the whole trade war between China and the US is also helping us to secure more supply for Africa, as Chinese manufacturers will have to rebalance their markets.
Have you seen that in the numbers? Have you seen a shift already being beneficial, the trade war benefiting the company?
Indirectly, yes. So we see that our pipeline of goods from China is getting healthier and healthier. We see that we have a lot more interest from Chinese suppliers and vendors. We run onboarding events for Chinese vendors in China. We have a team in Shenzhen. We now have more participants than we have chairs available. So we're really seeing a shift, and it's really making our lives much easier.
Can you talk, though, about the e-commerce play? Because you were in the food delivery business. You say potentially that was not the right decision. Is that sort of what you're alluding to?
What I mean is that we have to focus. Right, we're operating across 9 markets in Africa. Executing is difficult already in itself. If you're not focused, it's really hard to deliver something nice to customers. And we chose to focus on what we believe is the big prize, which is e-commerce for physical goods, for the real middle class of Africa. So people making between $100 and maybe $400, $500 a month.
Okay.
And that's the bulk of the market. Food delivery is quite a different business. You need different assets for sure. The synergies were not obvious, and I believe we're much stronger in the physical goods e-commerce.
If you take a look at e-commerce, though, people could say in a market like South Africa, there's Take-A-Lot, there's Shein, there's Temu. I mean, it's very competitive.
Yes.
How do you compete with companies that have really gotten quite a foothold on you over the past few years?
So South Africa is specific, right? It's very competitive with local players, Take-A-Lot and somehow Amazon, plus non-resident platforms. We're not in South Africa. We left South Africa last year. We had a very small business here, and we chose not to fight this battle. So we're actually now in 9 markets. We're dominant in almost all of those markets. We're number 1 player in 8 of the 9 markets. And we had very strong head start against any kind of competitor in those markets. We've built a business model that's relevant for this kind of market. We operate in markets where GDP per capita is between $1,000 and $4,000 per year, not per month. So it's very specific to some level of purchasing power. And we've built the right model for these customers in these markets, which is very different from South Africa. So we'll not fight the battle in South Africa. Definitely, it's a different business.
Do you expect, though, to face increased competition in some of these other markets? Let's take Nigeria, for example, where they've changed some regulatory hurdles, in particular the de minimis with duty-free imports. Do you expect to see more Chinese goods and players coming in and competing with you?
More, I'm not sure, but we expect to see competition from non-resident platforms, Temu, Shein, and the likes. So that we totally expect. For example, Temu came to Nigeria end of 24, and they made a big push there. But what we see now in the numbers is that we're able to fight them, and that money can't buy you everything in those markets, and that adapting to a market like Nigeria is tough, even for a platform like Temu.
And that's Next Africa for this month. But don't forget our weekly podcast for more of what's happening across the continent, available on Apple, Spotify, and wherever you usually get your podcasts. You can also subscribe to our bi-weekly Next Africa newsletter, available on the terminal and website, for even more reporting from the Bloomberg team. I'm Jennifer Zabasaja in Johannesburg. We'll see you next time.